Ladies and gentlemen, let me start with a fundamental distinction between the supply side and the demand side of the economy. The supply side is composed by the suppliers, including the producers, and it totally determines the productive capacity of the economy in the longer run. Keynes has focused on the short run and has demonized the so-called Sales law. But there is no doubt whatsoever that in the longer run, it is the supply side of the economy which determines not only the productive potential of the society, but also its purchasing power. And the supply side depends on a country's institutional system, including the property rights, extent of economic freedom, the rule of law, etc. Compare, for example, North and South Korea. No amount of monetary stimulation can erase or even mitigate the differences in the productive potential and the purchasing power of the two societies stemming from radical differences in their institutional system. It is therefore an aberration of the mainstream economics. It has largely neglected the supply side and has focused on the demand side policies. This has been true since at least the interwar period under the influence of Keynes. And it has become a fixation since the so-called great financial crisis of the 2007. And this brings me to the issue of the monetary policy of the Federal Reserve Board, followed by the central banks of other developed countries. This policy, called Unconventional Monetary Policy, UMP, consisted first by lowering the official interest rates to close to zero, and once it was judged insufficient stimulation, an unprecedented expansion of the monetary base has been added, so-called quantitative easing, QA. And UMP has been continued until the eruption of the present pandemics, and then it has been intensified. The main issue totally neglected by the mainstream macroeconomics is that the UMP damages the supply side and thus indirectly the demand side. Many economists, even before the great financial crisis, have pointed out that excessively low interest rates induce the booms and then the bust in the asset markets and thus damage the supply side of the economy and the economic growth. Another channel has been discovered in relation to the continued unconventional monetary policy, and namely that it can damage the real economy in a systematic way. I have in mind two kinds of impact. First, the UMP and especially interest rates close to zero induce the zombification of the economy because with extremely low interest rates, the commercial banks have incentives to continue lending to otherwise unviable incumbent firms. This lowers the allocative efficiency of the economy and thus economic growth. Second, By providing an extremely cheap money to the governments, the quantitative easing and the very low interest rates damage the incentives of the politicians to launch the necessary supply-side reforms. This systematic destructive impact of the unconventional monetary policy on the supply side has been denied so far by the central banks, despite a growing empirical research. What is more, in continuing this policy, the central bank used two doubtful arguments. First, that so-called natural interest rate, which is related, as we know, to the work of Wicksell, has declined, and that this justified the radical lowering of the official interest rates. Second, that inflation has declined since the great financial crisis over time and below the official targets. And thus, the UMP should be continued. Both arguments, as I said, are dubious, if not outright wrong. Regarding the natural rate, it should be remembered that it is a theoretical construct which has various empirical estimations. And the wrong estimations can lead to costly policy mistakes, as it was the case, for example, with the so-called output gap, another theoretical construct which had wrong empirical assessment. Besides, the natural rate has been probably lowered, reduced by the negative impact of the unconventional monetary policy on the supply side. With respect to inflation, one should remember that the central banks target the consumer price inflation, the CEP, and largely neglect the inflation of the financial assets, which resulted and is resulting from their own policies and especially the quantitative easing. And the inflation of financial assets contributes to the growing income inequalities and increases the risk of the next financial crisis. Regarding the CPI, it is true that it has been lower since the inception of great financial crisis and lower than the inflation targets of the central banks. But why? Here we come to the issue which has been strangely neglected by the macroeconomic establishment, that of money supply. Remember that over 90% of the money supply is created by the commercial banks when they grant credits. And this dominating part of the money supply has been growing slower than before the great financial crisis, despite the eruption of the monetary base. This phenomenon has been neglected by the monetary establishment, although I think it largely explains the low CPI so far. I don't have time here to dwell on the reasons for the strange behavior of the money supply. Let me only say that it can be to some extent linked to the side effects of unconventional monetary policy and other policies pursued since 2007. And this is another way how unconventional monetary policy has created the situations which then has been used by the central banks to justify the continuation of this policy. Isn't it a vicious circle? Summing up, the macroeconomic establishment has been conducted or justifying a very dangerous policy. It is up to other people to point out to its fallacies and to propose the alternatives. Thank you very much.